Are you looking to buy a home but are discouraged about coming up with the money for down payment? Are you a real estate agent who works with buyers who may need creative ways to help get their clients money for down payment? Then this is the episode for you. At the end, we'll also have 3 bonus programs to watch out for. So I'm Joe Harris, and this is Keeping Your Business on Track. I'm here with my buddy, Nick Morgan. How you doing, Nick?
I'm doing great, Joe. How are you?
I am awesome, as usual. Thank you for asking. God, that sounded a little pretentious in there, but that's okay. So we're here talking about down payment, right?
Right.
And so, again, one of the biggest barriers to entry to buy a house, people in their mind get stuck at the down payment.
Right. Yep. And the first probably barrier is that 20%, like we talked about, and we do have a podcast on that if you want to go check that out. But then the other thing is just in general, getting any kind of money for their down payment, whether it's less than 20% or it's the 20% or whatever. Right.
Let me make something abundantly clear that you do not necessarily have to put 20% down. Is this true?
Right.
Okay, good.
Yes.
Yeah, you don't have to. I mean, some people, because of their qualification, the home they're trying to buy, they might have to. Mm-hmm. But if you qualify, you can qualify for veterans, it could be 100% financing. If it's in a rural area, USDA could be 100%, no money down. You know, if it's a conventional conforming product, it could be as low as 3% down. Right. And FHA actually typically has the higher of down payment requirement of 3.5% down. Mm-hmm. It's not the only first-time homebuyer program out there. Mm-hmm. So there are some lower down payment requirements. But let's say you have, we look at your income. Can you afford the payment? We look at your credit. Do you have a history of making payments on time? And we look at the cash on hand or capital that you have to make sure that, you have the money to put down. And then we also look at the property, but that's once we find a property. Mm-hmm. But people are always saying, hey, what are some other ways I can get my money for down payment? And we're going to talk all about that. Now, before we do, this is very, very important, okay? If you're not a subscriber, please hit the subscribe button, hit the like button. If you find this valuable, share it with someone who you think might benefit from it. That's my shameless plug. We'll get going.
Sweet. All right. Yeah. So again, like you said, we're talking about, creative solutions for that down payment for your mortgages. And if we want to go into number 1, the most common I think that we see are gifts. You get gifts from family, I guess it has to be, but I guess you'll talk about a little bit.
Eligible gifter, we'll say.
Right, an eligible gifter.
Yeah, eligible gifter cannot be the seller cannot be the seller. Yeah. The seller can't gift you money for down payment. That would be looked at as mortgage fraud typically, which is very, very bad. We don't do that. There's other options. A relative, a close relative, family member. Mm-hmm. It can be someone that's lived with you, like a fiance or a spouse even. It could come from your employer. Mm. Okay, and I think we're going to talk about that next. But yes. But the gifter, and this is very common. We find this a lot. The parents gift money to a son or daughter, or it can happen the other way around. I've seen son or daughter trying to help mom and dad buy a house, and they gift them money that way too. Mm-hmm. It can be from a fiance that's been living with you to help buy this house. They might not be on the loan, but you're going to be on the loan, and they're going to contribute and gift money to you. Yep. The main thing about a gift is it has to be truly a gift. It can't be It can't be a promise to repay. That's not a gift.
Mm-hmm. Yeah, yeah, and there's a little form that you'll sign saying, "Hey, this has no repayment." Right, so it's not like a loan to get a loan.
Yeah, right. Yeah, if you're typically getting a loan to get a loan, could be bad. Now there is a certain circumstance where this is okay. Mm-hmm. If you're buying a second home. And you pull equity out of your current home through like a second mortgage or something, but you can't go get a credit card loan to buy a house because that's debt. Yeah. You're debt to get debt.
Right. Yeah.
Although so is a second mortgage, but the second mortgage is collateralized with property or securitized with property. Mm-hmm.
Yeah, like you said, there's definitely instances where you can do that, but for a gift, for the definition of a gift, it
has to be a gift.
It has to be just that, a gift without repayment.
For those of you who don't know, Nick actually went through underwriting school and helped us in processing and underwriting for a little bit. So he's more than just a pretty face on the show here.
Yes. Yep. Yes. It's cool. So number 2, like you touched on a little bit at the beginning of when we were talking about gifts, is employer assistant. So how can your employer, whoever you work for, help you out with down payments?
Well, like you said, I mean, the employer, there are some employer programs, and there might be a relocation. If you're relocating, and some employers, depending on the job, they might give you relocation funds. And, obviously these have to be documented properly and have to be eligible for the program, but we see that happen quite a bit. The number one thing we see is gifts, though, from family members typically. But we also see these types of things happen out there where, the employer, whether it be a bonus or a down payment program that they do or something, we've seen that as well.
Cool. Sweet. So then the third one then brings me to borrow from retirement accounts. So
right. Debt to get debt. We just said earlier that that's not really a thing, but it really is.
Yeah.
Because it's your money you're borrowing from. So retirement funds, let's say you have a 401k and you have a couple $100,000 in there. So you've been working for several years, putting a lot in there. Depending on the program and depending on your fund, you can borrow against your 401k, pay yourself back plus interest for the purchase of a primary residence. Now, obviously, talk to your fund manager, make sure you're eligible for this, look at tax implications and all these things to feel comfortable with it. But there is that option out there. And a lot of times when I mention this to people, they had no idea.
Yeah.
They had no idea, and they have good income, great credit, and they have all this money saved up in a 401k, and they think, well, I can't touch it, it's just in my 401k.
Right.
But you can borrow against it and pay yourself back the interest, which I think is really cool.
Yeah, no, that's a great solution that I don't think a lot of people even consider. They don't even think about it because it's like, I can't touch that money.
But we've helped people that again had 3 out of the 4 things you need, and that 4th thing was the down payment money, or the 3rd thing, depending on how you look at it, was the down payment money, and yet they had all this money sitting in a 401k.
Right.
And I'm like, have you thought? And obviously your fund manager doesn't want you to pull that money out because then they get paid less. There's less money in there. Maybe I'm wrong, and most people don't think that way. It's such a minimal amount. I'm making jokes, but the reality is that you might be able to do that, but get all the info. What are the tax? Are there tax implications? What are they? How much is that payment going to be? Is that something I'm comfortable with doing?
Yeah.
Do I want to pull my money out of the market for a couple of years so I can repay it back for the purchase of this home? If you think the market's going down, that might be a good option. If you think it's going to go up, maybe you look at other means, but you have options out there.
Yeah, a lot to consider, but just another option that you can look at and could possibly work out for you. So that moves on to the 4th thing I want to talk about, which is not maybe something that you can pull from, but a process that you can start, which is a down payment savings plan. If you could talk a little bit about that. Well,
really, that's just putting money away for a down payment and just starting to save for that down payment. It's forced savings. Now, was that what you had in mind, or am I missing something?
Yeah, no, it's just along those lines that you kind of create an account dedicated for the down payment, just chipping away at it.
Yeah, there were some other ones that we came up with and talked about that were they're not necessarily bad. They're good for the right person, but there are some things you got to watch out for. Okay, and so what's the first one of these things?
The programs. Right. We have the down payment assistance program.
Okay,
right?
So down payment assistance programs.
Yeah.
Free money is great, and who wouldn't want it, right? But you got to make sure there's not a cost or a hidden cost to that money. And so with down payment assistance, again, for the right borrower, and it works out, awesome. As long as you understand what you're getting into, it might not be free money. There might be a payment associated with it. There might be tax implications from it. There might be a repayment promise to repay, or it might be due whether you refinance or sell the house. So you got to make sure you understand the parameters. Don't just get enticed by, they're giving me $10,000 of free money, because there's no such thing as a free lunch, right? So in most instances, sometimes there is, but usually these things come with strings. Just make sure you know what those strings are and you're good with them. And it could be a very viable, great program for you, but just get the facts.
Yeah. Another one that people might try is crowdfunding.
Crowdfunding.
So I don't know if you have any experiences with that or comments.
I've given money to GoFundMe's for people that have been in accidents and things like that.
Yeah.
And this is great for that. Now, I have seen, and this is actually, if you chat GPT, creative financing or whatever, it will come up with this, because I did this. I'm not going to lie. I look at chat GPT all the time. But on this one, there's more to it. If I go out there from an underwriting standpoint, if I see a borrower that has crowdfunded money and they're using that as down payment, what's not to stop the seller from giving money to that down payment assistance, and then the borrower getting it from the crowdfunding? And so really the seller is funding the down payment.
Right.
And that's a big no-no. That's mortgage fraud. Okay. Because it's an enticement to purchase, or it's not on the HUD or the closing disclosure,
right?
Then it's really not supposed to be. So the seller is not an eligible gifter. So crowdfunding, why it might seem like it makes sense, I can go out there and basically public or digitally panhandle for money for my down payment. Most underwriters are going to want to know where that money came from.
Yeah, for sure. That one just intrinsically feels like it could get a little bit messy for a whole slew of reasons.
So I would probably not discourage people, but I would say get the facts and see if your lender allows crowd-funded sources of funds prior to saying this is my strategy.
Cool. Yeah, and the third one of those programs is a lease-to-own program, which I think a lot of people are familiar with, but yeah, maybe you could talk about that.
Sure. The lease-to-own program says, look, if here's market rent, you're going to pay a little bit more than market, and every month your landlord will put money away and give it back to you for the purchase of the house, and that's all negotiated up front. And so there's this is not necessarily a bad thing. All these things are not necessarily bad. They could be very helpful in the right situation. Where it does, I have seen problems with it, is that the borrower didn't negotiate or lock in a price up front, or they locked in a price that's high up front, and they didn't really have an out clause, and almost had or lost money to buy that property. So be very careful about how these leases are written. I personally don't really advise them, but sometimes they might make sense. And so where it doesn't make sense is where if you have to buy the house at market rent in 2 years, or market price in 2 years, well, what's the point of giving your money to someone else to hold for you? Why don't you just save your own money? Because if the market rents are here and you're paying here, and the landlord says, I'm going to give you some money back, as a lender, we can't count that because you didn't pay over and above the market rents, right? So there's lots of rules surrounding this.
Yeah.
So make sure, if you are going to go into this lease to own type situation, make sure you talk to a lender ahead of time to make sure that you're doing it the right way, where we can actually count those funds when you go to buy that house, because it becomes a non-arm's length transaction. And there's lots of rules that surround all of this. Make sure you're set up for success, not failure on this. And it might work out very well for you, but just know that there's some red flags along the way that you got to be careful of.
Yeah. Cool. Sweet. Well, that wraps up all three of those extra programs that we want to talk about. Yeah.
Well, thanks again for watching today. If you have any questions, comments, concerns, if you want real honest advice from a professional loan officer in the state of Florida, there's some contact information down below. Otherwise, we'll see you next time. Thanks for joining us. Talk to you soon.